Hi, today I want to talk to you about what the Monte Carlo analysis is in the financial planning process. A Monte Carlo analysis basically will tell you, do you have enough money to make it through retirement without running out of money? Will you be able to grow your account with withdrawals and inflation and still have money left over? Every year, typically, gas will go up, food will go up, utilities will go up, and other living expenses will go up. And you need to keep up with inflation while living. So a Monte Carlo analysis will analyze what's called the sequence of returns. So if the market went up at a steady 7% rate every year, it'd be simple. But the market doesn't go up at a steady 7% rate every year. Sometimes it'll go down 12%, up 11%, up 10%, down 9%, and so on. And so what a Monte Carlo analysis does is runs through typically 10,000 different trials, up markets and down markets, and says, are you going to be okay? So let's look at an example. Let's say Dave retires, and for simplicity's sake, he has $1 million in his portfolio. He needs $40,000 to live on every year. So $40,000 is basically 4% of $1 million. Let's say Dave retires at the end of the year, and in the first year, the market goes down immediately 12%. And he takes out 4%. Now he's down 16%. So at the end of year one, 1 million minus the 40,000 he withdrew, minus the 12% or 120,000 that he lost, now the account value is worth $840,000. At the beginning of year two, he doesn't have $1 million anymore. He has $840,000. So if he takes out $40,000, that's now 4.76% of the portfolio. It's a much higher withdrawal rate. So typically you may hear that you can take out 4% of your account value and be okay. That may be true, that may not, depending on the market. It depends on how aggressive you are, how much do you have in stocks. If you're super conservative and you have everything in CDs and you're only earning 2%, taking out 4% will draw your account value down every year. So what a Monte Carlo analysis does, it runs through 10,000 different trials, up markets and down markets, and basically asks, are you going to be okay? So of the 10,000 trials, the first trial may be down 12%, up 8%, up 12%, down 11%, down 9%, and it looks at the withdrawal rate and says, are you okay? And then it does another trial. It may say up 5%, down 4%, up 3%, down 11%, and so on. And so it does this 10,000 different times. And it'll give you a confidence level and say, based on these different random market cycles, are you going to be okay? It may give you a probability of success anywhere from 0 to 99%. It will never give you 100%, but if you're in the 90 and 90% range, you know you're going to be pretty well off. It's going to account for inflation as well. So if you had $1 million portfolio and you needed to withdraw $40,000 a year or 4%, you also need to account for inflation. So you may need the 4% plus a 3% inflation buffer to have a target return of 7%. Now, as we talked about before, the market doesn't go up at a standard 7%, but it gives you basically an idea of what kind of target return you need to have over the long term. So let's look at another example. Let's say Dave had $1 million in his portfolio, and he needed to take out 4% a year on a steady 7% rate of return. If the $1 million portfolio earned 7% the first year, you'd have $70,000 at the end of the year. If you took out $40,000 and you had 3% built in for growth, at the end of the year, he would have $1,030,000. Let's say he earned 7% again on the second year and took out 4%. The next year, that 4% is not $40,000, it's $41,200. And the 3% growth rate on $1,030,000 is now $30,900. On the third year, now the portfolio is worth $1,060,900. 4% of that portfolio is now $42,436. And his growth of 3%, in addition to the 4% withdrawal, leaves him close to $1.1 million. So it leaves him with $1,030,000 $92,727. So steady growth rates can help. Obviously, that doesn't happen, and so that is the purpose of Monte Carlo analysis. But every year, you need to account for inflation when you're taking out of your portfolio. So you don't want to have just a steady 4% withdrawal for $1 million or $40,000 a year, and maybe that you have to factor in what things are going to cost in the future. So what can things buy in today's dollars? You're going to want to have a high success rate for your core expenses. So if you know you need $70,000 a year to live on, and you have $30,000 coming from Social Security and pension, you're going to need to make up the difference from your portfolio. You want to have a high success rate for that amount in order to know you have your core expenses covered. If you do, and you have extra things in there like travel or gifting or fun items, you may be able to look at those too and see, am I going to be able to withdraw the portfolio from there? It may be that the market's up and you can spend more money. If the market's down, you might have to be a little more cautious. But the idea with the Monte Carlo analysis is each year the market will go up and down. And so you basically want to refresh your portfolio or your financial plan and say, based on what actually happened, here's what we thought was going to happen. Based on what actually happened, am I doing okay or am I still on track? So when we look at an overall inflation rate, inflation can really eat into your expenses over time. When you look at what $40,000 is in today's dollars, if you account for 3% inflation, $40,000 in year one becomes $41,200 in year two. By year 5, it's $45,020. By year 8, it's $49,195. And by year 10, the same $40,000 in today's dollars with 3% inflation becomes $52,191. So you really need to pay attention to your numbers. You need to pay attention to your budget. You need to set your budget now so you know what you're going to spending now and what you're possibly spending in the future. And take a look at that and sit down with a financial planner, run the financial plan, but also factor inflation and growth in the portfolio. Growth will change and your success rate will change based on your portfolio. So if you have 100% stocks, you may have a high expected return long term, but it can be pretty volatile in the short term. So if you're in retirement with a lot of stocks, expect more volatility. If you have all bonds or all CDs and all cash, you may not have any volatility or very little volatility, but no growth. And so the core idea is to have a mix of a portfolio of stocks and bonds, let's say 70% stocks and 30% bonds, that matches your risk tolerance, matches your budget, looks at the Monte Carlo and says, based on what we're projecting, am I going to be okay? If you have any questions, please feel free to reach out. We'll be happy to help.